Hello students, welcome to the last lecture that we're going to be having over chapter 14, which deals with financial statement analysis. This is Accounting 2401, Principles of Financial Accounting, and I am Mrs. Mercado. So, in this particular chapter, we're going to learn a variety of financial statement analysis techniques to analyze our financial information. Okay, so the basic financial statements provide important information that users rely on to make economic decisions. Financial statement users usually evaluate this information along three dimensions, which include liquidity, solvency, and profitability. Okay. There are several techniques that are utilized to analyze a company's financial performance and condition, but the two main ones are analytical methods and ratios. Both analytical methods and ratios can be used to compare a company's financial performance over time or compare it to another company that's similar in size or in the same industry. That way they can see, okay, how do we stand in comparison to my competitors, and then be able to identify, are we doing better than them? Are we doing worse? Areas of improvement, things of that sort of nature. So there's a lot of ratios that are going to be calculated. There's going to be horizontal analysis, vertical analysis techniques that are applied to existing information. Okay, I'm going to focus on three problems in this particular lecture. Let me just grab my syllabus real quick. Okay, so let me see, chapter 14, over here. Okay, so in your final exam, you're going to be having three problems over chapter 14. Okay, the first problem is going to be similar to exercise 14.6, which deals with current position analysis. The next problem that I'm going to go over that's also going to be on your final exam deals with profitability ratios, and that is exercise 14.17. And then last but not least, we're also going to be having on our test, on our final exam, a horizontal analysis of an income statement. That's going to be problem 14.1a. Okay, I'm going to focus on those three problems that I know for sure we're going to have on our final exam. That way you know how to solve them. Okay, you do have additional problems for homework like every week, but I'm going to let the rest of the problems you attempt them on your own. I'm going to focus on ensuring that I cover the three problems that you're going to be seeing on your final exam. If whenever you're working on your homework, you have any issues or any questions, you can always reach out to me. But for time constraints, I'm only going to cover those three problems because I know that it can take a while. I know my lectures are pretty long in comparison to maybe some other lectures in other classes, but I need to make sure that I do cover this content. That way you are prepared for when you have your exams. Okay. So I'm going to jump right into the first exercise that we're going to be covering. This is exercise 14.6. So it says current position analysis. The following data was taken from the balance sheet of Nilo Company at the end of the recent fiscal years. Okay. Then they give us the information for the current year and the previous year. It says determine for each year the working capital, the current ratio, and the quick ratio. Round ratios to 1 decimal place. Okay. So we're being asked to calculate three ratios. Okay. Working capital, current ratio, and quick ratio. Okay. So let's start off with the working capital. Okay. What I did here is I grabbed a section from your ebook that talks about working capital. That way, before we calculate it, we know what we're dealing with. Okay. So working capital. This is a company's working capital is computed as follows. Your working capital equals to your current assets minus your current liabilities. The working capital is used to evaluate a company's ability to pay its current liabilities. Okay. Now, the working capital formula is composed of two elements. The first one is current assets. The second one is current liabilities. I wanted to clarify what these are. Okay, so current assets is cash and any other assets that are expected to be converted to cash or sold or used up, usually within 1 year or less, okay, through the normal operations of the business. A current liability are liabilities that will be due within a short time, usually 1 year or less, and that are to be paid out of the current assets. Okay, so this is what the formula is. Now that we have the formula, we can do the calculation. Okay, so it's current assets minus current liabilities. Okay, so we're going to look at the information provided. And if we look at the data here, everything we need was provided. Let me just, my computer's a little bit slow today. Okay, so right here we have our total current assets. Excuse me, let me see. Let me try this again. Total current assets, here we go. So right there we have our total current assets. Just let it load. There we go. I don't know why my computer's so slow this morning, but we have to work with what we have. What else can we do? Okay, shape, no fill. Okay, so the first component is total current assets. Okay, total current assets. Next we have current liabilities. Okay, so we're going to look at our liabilities. Okay, and I'm highlighting them, that way you can see what is it that I'm getting. Okay, that way you can follow along. Okay, so those are the two components that we're looking at: current assets and current liabilities. Okay, so let's do the current year. Okay, current assets for the current year is $2,090,000. Okay, sorry. Like I said, there's a delay in my computer right now. So it's $2,090,000 minus my current liabilities of $1 million. So that is what I'm going to be doing. Okay, so now I can do the math. So it'll be $2,090,000 minus $1 million. That will give me $1,090,000. Okay, so my working capital for the current year is $1,090,000. Now I'm going to do the same thing for the previous year. Okay, so for the previous year, my current assets are $1,440,000 minus my current liabilities of $900,000. And let's see what that gives me. Okay, $1,440,000 minus $900,000. Okay, that gives me $540,000. So my working capital for the current year is $1,090,000. For my previous year is $540,000, and I'm getting that information from the data provided from a balance sheet. Okay, so that is the first item that we're being asked to calculate: working capital. Okay, now the second thing that we're being asked to do is to calculate the current ratio. Okay, so the current ratio is sometimes called the working capital ratio, is computed as follows. So the current ratio is your current assets over your current liabilities. Okay, the current ratio is a more reliable indicator of a company's ability to pay its current liabilities than is working capital, and it is much easier to compare across companies. So a lot of companies, well, the majority of the companies, when they do their financial statement analysis, they include a whole bunch of ratio analysis, current ratio being one of them. Okay, so to calculate the current ratio, we're going to have our current assets divided by our current liabilities. So it's basically the same numbers that we're going to be using, but in the first one, in the working capital, we subtracted. In the second one, which is the current ratio, we're going to be dividing. Okay, so we're going to be doing the $2,090,000 divided by the $1 million. Okay, so you're going to get the same factors, which is current assets, $2,090,000 divided by current liabilities of $1 million. Okay, and let's see what that gives us. 2,090,000, 1, 2, 3 divided by $1 million. That gives me 2.09. Now, very careful here. It says round ratios to 1 decimal place. So we have to look at that second digit. That's a 9. So that means that I'm going to round it up to 2.1. Okay? Okay? 2.1. Now, the second one is going to be $1,440,000 divided by 900,000. Okay. So let's see what that gives us. $1,440,000 divided by 900,000. That gives me 1.6. Okay, so my current ratio for the current year is 2.1. For the previous year is 1.6. Okay. The last thing we're being asked to do is to calculate the quick ratio. Okay, so a ratio that captures the difference and measures the instant debt-paying ability of a company is the quick ratio. This is also called the acid test ratio. The quick ratio is computed as follows. Quick ratio equals your quick assets over your current liabilities. Now, we need to identify what my quick assets are. Okay, so quick assets are any cash and other current assets that can easily be converted to cash, such as temporary investments and accounts receivable. So quick assets normally include cash, temporary investments, and receivables, but it excludes inventories and prepaid assets. Okay, so that's very important to know for when we're calculating our quick assets. Okay, so the problem says that we should include cash, temporary investments, and receivables. Okay, so let me go ahead and highlight that. Cash, marketable securities, and receivables. Those are the three components that we're going to be looking at. Okay, for both years. And this is our quick assets. Okay, so that is what we're going to be looking at. These three components right here: cash, marketable securities, and accounts receivable. Okay, so we're going to go ahead and we're going to add those three components, and let's see what we get. Let's do the current year first. 391,000 plus 515 plus 634,000. That gives me $1,540,000. So that is my quick assets, $1,540,000. Okay, so I'm going to get my $1,540,000, and I'm going to divide by my current liabilities. Your current liabilities are provided right here. Current liabilities are $1 million. So we're going to divide by 1,000,000. Okay, and let's see what we get. 1,540,000 divided by 1,000,000. Okay, and remember they're asking us to round to one decimal place, so it'll be 1.5. Okay, now we're going to do the previous year. So let me get my calculator. Okay, so to calculate my quick assets, I'm going to add my 300,000 plus my 354,000 plus 426,000. That gives me 1,080,000. Okay, so now that I've got that number, I'm going to go down here and I'm going to do 1,080,000 divided by, and then my current liabilities are 900,000. Okay, and let's see what we get. 1,080,000 divided by 900,000. That gives me 1.2. Okay, so we've done all of the three calculations that they ask us: our working capital, our current ratio, and so let me highlight these. That way I know that these are my solutions right here. Okay, to my calculations. Okay. Okay, so now that is requirement A, doing the three ratios. Now, what conclusions can be drawn from these data as to the company's ability to meet its currently maturing debts? Okay, so we have to analyze the ratios that we just calculated to be able to draw conclusions based on the data. Okay, let me make a little box here so I can write or type up my answer. Okay, so if we look here at the working capital first, okay, the previous year we had working capital Excuse me. The previous year we had working capital of 540. It increased to 1,090,000. So we saw improvement in our working capital. My current ratio went from 1.6 to 2.1. It increased from the previous year to the next year. So that demonstrates improvement in our ability to pay our current debt. Okay. My quick ratio went from 1.2 to 1.5, also noting improvement. So I can say here that, let me just go here, the liquidity of NILO has improved from the preceding year to the current year. The working capital, current ratio, and quick ratio have all increased. Okay. Most of these changes are as a result of an increase in current assets relative to current liabilities. Okay. So if we look back at our information presented here, we can see, you know what, last year my current assets were 1,440,000. They went up to 2,090,000. A very significant amount of increase in my assets, while my liabilities only increased by 100,000. So because my current assets increased, okay, I'm in a better position to have liquidity to pay off my debts. Okay, so cash went up by a little bit. Your marketable securities went up significantly, and your accounts receivable also went up. Okay, so if you do collect on your receivables, you cash in on your marketable securities, then you're in very good financial position to be able to pay any current liabilities that come due. Okay, so that is the analysis that we can observe from the three ratios and from the data presented. Okay, be very careful when you're doing your ratios. Make sure that you follow the instructions. It says to round decimals in this particular problem to one decimal place. Okay, make sure that you do your rounding correct. This is an area where I see a lot of students struggle in their rounding. Make sure that you're careful. You look at that third digit, or in this case the second digit, because you're only rounding to the first digit. You look at the second digit, and if it's greater than a 5, you round up. If it's less than a 5, you keep the number as is. Okay. So this is the first problem that you're going to have on your test. Okay. The next problem deals with profitability ratios. Okay. This is exercise 1417. Okay. So it says the following selected data was taken from the financial statements of Vita Hill Incorporated for December 31st, 20Y7, 20Y6, and 20Y5. Okay. And they give you all of the information. Okay. The 20Y7 net income was $372,000. And the 20Y6 net income was $492,000. No dividends on common stock were declared between 20Y5 and 20Y7. Preferred dividends were declared and paid in full in 20Y6 and 20Y7. So, the first requirement, determine the return on total assets, the return on stockholders' equity, and the return on common stockholders' equity for the years 20Y6 and 20Y7. We are being asked to round percentages to one decimal place. So, the first one, the first ratio that we're going to be calculating is the return on total assets. Okay, so the return on total assets measures the profitability of total assets without considering how the assets are financed. Okay, in other words, this ratio is not affected by the portion of assets financed by creditors or stockholders. Okay, so I don't care how you acquired your assets, if you acquired them through debt or through stockholders. It includes everything. Okay, so the formula is your return on total assets is equal to your net income plus your interest expense divided by your average total assets. Now we have three different components here: net income, interest expense, and average total assets. Okay, the net income is provided. Okay, the net income for the 2 years is provided right there. Okay, so that one we don't have to calculate. Okay, how about interest expense? Do we have any amount here that deals with interest expense? No, that is something that we are going to have to calculate. Okay, so we know that we have a note. Okay, and then we know that we are charging, or in this case, we have a notes payable. We owe this money of $2,250,000 basically every year, and we are being charged 8% interest. Okay, so we have to pay 8% interest on this note. Okay, so based on this data, we can calculate our interest expense for the year. Okay, so let's gonna look at 20Y7 first. My note is $2,250,000. I'm going to go ahead and I'm going to multiply times my interest rate, which is 8%. Let me just sort this right here. Okay, and let's see what we get. So it's going to be $2,250,000 times 8%. Okay, and that's going to give me $180,000 of interest. Okay, so that is my interest expense calculation for 20Y7. Now, they're also asking you to divide over your average total assets. Okay, so you are given your total assets, but you're not given the average. You have to calculate your average total assets. So let's do that for 20Y7. Okay, so to calculate your average total assets, you're going to get the current year's total assets, okay, which is $4,800,000. Okay, you're going to add prior year's total assets, which is $4,400,000, and then you're going to divide by 2. So let's see what we get. Sorry. So we're going to get 4,800,000, 1, 2, 3, plus 4,400,000, 2, 3, and then we're going to divide by 2. Okay, and that gives us 4,600,000. Okay, so these are my calculations for the year 20Y7. Okay, now that I've got all of my components, I can be able to do my actual calculation for my return on total assets. So your return on total assets is your net income. So we're going to get the net income of $372,000 right here. $372,000. Okay, I'm going to add my interest expense, which is $180,000. And I'm going to divide by your average total assets, which is $4,600,000. Okay, so that is what the formula is going to look like. Okay, so let's see what that gives us. 372,000 plus 180 divided by 4,600,000. Okay. Now I need to convert that into a percentage. I'm using Excel, so I can just convert. I can just hit the percentage sign, and it converts it into a percentage. Now they're asking you to round to 1 decimal place. I can just pull it out, and they'll give me 12%. Okay. Now let me show you. If I were doing this in a calculator, okay, because I want to make sure I'm clear here. Okay, I'm going to do the same calculation. 372, 1, 2, 3 plus 180. That gives me 552,000, and I'm going to divide by 4,600,000, 1, 2, 3. That's going to give me 0.12. Okay, I'm going to multiply by 100 and that converts it into a percentage. Okay, that'll be 12%. Okay, I'm going to do the same thing for 20Y6. The first thing I'm going to do is I'm going to calculate my interest expense. Okay, and remember, when we're calculating our interest, we are looking at our notes payable right there. Okay, so interest for 20Y6, my note was for $2,250,000, the same, and I'm going to multiply by 8%, and that gave me $180,000. I had already calculated it in the first one. Nothing changed. How about my average total assets? Okay, for my average total assets, I'm going to get the current year's total assets, which is $4,400,000. I'm going to add the prior year's total assets, which is $4 million. And then I'm going to divide by 2. And let's see what we get. Plus 4 million. And I'm going to divide by 2. So that gives me $4.2 million. Okay. Now that I've got these components calculated for 20Y6, I can do my actual return on total assets calculation. Okay. So my net income for 20Y6 is $492,000. I'm going to add my interest expense for 20Y6, which is $180,000. And I'm going to divide by my average total assets for 20Y6, which was $4,200,000. And let's see what we get. 492, 1, 2, 3, plus 180, 1, 2, 3, divided by 4,200,000, 1, 2, 3. And that gives me 0.16 converted to a percentage, 16%. Okay? So I have done both of my calculations for my return on total assets for 20Y7 and 20Y6. Okay? The key here is, first of all, identifying the 3 components. If you need to do any additional calculations, such as for interest expense, I ran those numbers in the bottom. That way you could see how I came up with those numbers. Okay? And then I'll just plug in my numbers from my actual components into my formula. Okay. The next item we're being asked to calculate is the return on stockholders' equity. So the return on stockholders' equity measures the rate of income earned on the amount invested by the stockholders. It is computed as follows. So your return on stockholders' equity is your net income divided by the average total stockholders' equity. Net income divided by the average total stockholders' equity. Okay? So, the first thing we need to figure out is, what is my average total stockholders' equity? Okay? So, your the average total stockholders' equity is not provided to you in the problem. You have to calculate that. Well, what is my total stockholders' equity, first of all? Well, your total stockholders' equity is any investment by your stockholders into the business, and this is usually in the form of stock, or this is the retained earnings of the income generated by the business. Okay, so stockholders' equity is composed of common stock, preferred stock, and retained earnings. Okay, these are the 3 components that we have to look at for when we deal with stockholders' equity. Okay, just like when we prepare our statement of stockholders' equity, it's our retained earnings and our stock. In this case, we have common and preferred stock. Okay, so that is your total stockholders' equity, but they're asking for the average. So whenever they're asking for the average, we have to do a calculation to be able to calculate that average. So I'm going to do the calculation for, this is my average total stockholders' equity for 20Y7. Okay, so we're going to first get the sum of these three components, okay? And maybe I'll do like a little 20y7, okay? So it'll be the 250,000 plus 500,000 plus 1,574,000, okay? So all I'm doing is I'm picking up these three numbers right here for 20y7, okay? And let's see what that gives us. 250, 1, 2, 3, plus 500, plus 1,574,000. That gives me 2,324,000. Okay. 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 Now I'm going to do the same thing, but for 20y6. Okay. Okay. For 20y6, I've got 250, 500, and 1,222,000. So it'll be 250 plus 500 plus 1,222,000. And let's see what we get. 500,000 plus 1,222,000. We get 1,972,000. Okay. Okay. 1,972,000. Okay. Now, because we are getting averages, we are going to be needing my total stockholders equity for each year. Okay. So we're going to be doing 20y5. And for 20y5, I've got 250, 500, and 750. Okay. Plus 750. So all I'm doing is I'm adding these three components for each of the years. That's all I'm doing right now. Okay. So it'll be 200 plus 500 plus 750. That gives me 1,450,000. Okay. But let me rerun these numbers. Okay, so I've got 200,000, 200, 1, 2, 3, plus 500, 1, 2, 3, plus 750, 1, 2, 3. Did I pick up the numbers correct? Let me see. 200, 500, and 750. Oh, the first one is not 200, it's 250. I was like, why am I getting an incorrect amount here? There we are. You see how easy it is to make a mistake? Okay, so it's 250 plus 500, 1, 2, 3, plus 750. So that gives me 1.5 million. Yep, that makes sense. Okay, 1,500,000. Okay, so I've calculated my total stockholders equity for the 3 years, and I just did that by adding common stock, preferred stock, and retained earnings. Okay, now we can do our calculations and figure out our average total stockholders equity. Okay, now to figure out your average total stockholders equity, okay, I'm going to calculate my average down here. Okay, so to calculate your average, you're going to do the current year's total stockholders equity for my current year's total stockholders equity is 2,324,000. I'm going to add my prior years, which is 1,972,000, and I'm going to divide by 2. Okay. So what are we doing here? Okay. What we did down here is we just calculated our total stockholders equity for each of the years, and we did our total stockholders equity. Maybe I should put here insert. This is my total stockholders equity by year. Okay. So this is my total stockholders equity by year. Now that I've got my total stockholders equity by year, I can calculate my average total stockholders equity by getting my current year's total stockholders equity plus my prior year's divided by 2. Okay, now let's see what that gives us. 2,324,123 plus 1,972,123, and we're going to divide by 2. Okay, so my average stockholders equity for 20Y7 is 2,148,000. Okay, 2,148,000. We're going to do the same thing for 20Y6. For 20Y6, I'm going to start off with my 20Y6 number, which is 1,972,000. I'm going to add my prior years, which is 20Y5, which is 1,500,000. And I'm going to divide by 2. So let's see what that gives us. Okay, so that'll give me 1,972,123 plus 1,500,000, and I'm going to divide by 2. That gives me 1,736,000. Okay, so now I calculated my average total stockholders equity. Remember, when we're calculating an average, we get our current years plus our prior years divided by 2. Okay, of whatever component is it that we're getting our average for. Current year plus prior year divide by 2. Okay, now that we have this calculated, we can do our actual return on stockholders equity calculation. Okay, so that's going to be my net income, which in this case we had net income of 372,000 for a 20Y7 right here. And I'm going to divide by my average total stockholders equity for the current year, which is, we calculated it to be 2,148,000. Okay, and then that's going to give me 372 divided by 2,148,000. Okay, and now they're asking us to round to 1 decimal place. Okay, so 1 decimal place, and I'm going to do this in a percentage. Okay, so it'll be 17.3. So if I would have done this in my calculator, I would have done 372 divided by 2,148,000. Then I get that number. Once I get that number and multiply it by 100, that gives me 17.318. I will look at the second digit, which is a 1. Because it's less than 5, I'm going to keep it at 17.3. Okay, percentage. Okay, so I'm going to do the same thing for 20Y6. For 20Y6, my net income was 492. I'm going to divide it by my average total stockholders equity for 20Y6, which we calculated it to be at 1,736,000. And let's see what we get. Divided by 1,736,000. 1, 2, 3. And then it's going to be a percentage format to 1 decimal place. So that will give me 28.3%. So in 20Y6, it was 28.3. In 20Y7, it was 17.3. Okay, that is my second calculation for my return on stockholders' equity. The last ratio that they're asking us to do is the return on common stockholders' equity. So, the return on common stockholders' equity measures the rate of profits earned on the amount invested by the common stockholders, and it is computed as follows. So, the return on common stockholders' equity equals your net income minus your preferred dividends over your average common stockholders' equity. Okay? Average common stockholders' equity. Okay? So, there's 2 components here that we don't know. The preferred dividends and the average common stockholders' equity. Okay? So, let's look over here at our problem. Okay? To be able to calculate our preferred dividends, we're going to look at our preferred dividends. It says we have preferred 4% stock, 100 par, and there was no change during the year. So every year it's been 500,000. And we have preferred of 4%. So we need to figure out our preferred dividends, And to calculate our preferred dividends, I'm going to get the amount that we have, which is 500,000, and we have 4% preferred, so we're going to multiply it by 4%. Okay? So it'll be 500,000 times 4%. And let's see what we get. Okay. We get 20,000. Okay. So we have 20,000 in preferred dividends. Okay. The other component that we have to calculate is my average common stockholders equity. Okay. Average common stockholders equity. And they're being very specific, average common stockholders equity. Okay, so to calculate your average common stockholders equity, okay, we're gonna add our retained earnings plus our common stock, because they're only wanting our common stockholders equity. Okay, so it'll be the 1,574,000. Okay, maybe I should do that like I did on the other ones. Let me delete this. Okay, so for my average common stockholders equity, that's gonna be shapes. I'm gonna be doing my common stock and my retained earnings. Okay, so I'm gonna add my 250,000 plus my 1,574,000. And let's see what we get. 1,574,000 plus 250, 1,824,000. Okay. Now we're going to do the same thing. That was for 20Y7. Okay. Okay, so for 20Y7, I've got that. Now for 20Y6, I've got 250,000 in common stock and 1,222,000 in retained earnings. Okay, so 1,222,000 plus 250, and let's see what that gives us. So 1,222,000. 1,222,000 plus 250. That gives me 1,472,000. Okay. Okay, and then we're gonna do the same thing, but now we're gonna do 20Y5. So for 20Y5, okay, I've got 250,000 in common stock and 750 in retained earnings. Okay, so 750 plus 250. 750 plus 250. That gives me $1 million. Okay, so these are my common stockholders equity by year. Common stockholders equity by year. Let me insert the title right here. Insert. So this is my common stockholders equity by year. Okay, it's not the average, it's just the common stockholders equity by year. And how do we get the common stockholders equity by year? You get your common stock plus your retained earnings. Okay, common stock plus retained earnings. Okay, common stock plus retained earnings. Okay, that is how we got these numbers. Okay. Oh, I put it in the wrong in the wrong cell. Copy, paste. There we go. Okay, so my common stockholders equity by year, and then I can do here common stock plus retained earnings. There we go. Okay. So for your common stockholders equity, it's your common stock plus your retained earnings. We got these numbers. Now that we've got those numbers, I can calculate my average common stockholders equity. And how do we calculate an average? You get the current year plus the prior year, divide by 2. Okay. So I'm going to calculate my average stockholders equity for 20Y7. And then for 20Y6, because I'm going to need those two numbers. Okay. Now, my preferred dividends, I only need one calculation, because if you look at your dividends, it's $500,000 every single year, and it's 4%. So 27, 26, 25, it's going to be $20,000. Okay. Now, for the average common stockholders equity, there we are going to see a change. So what are we going to do to calculate our common stockholders equity? We're going to get our current year, which is $1,824,000. $1,824,000 plus prior years, $1,472,000, divide by 2. Okay, let's see what we get. And I'm getting these numbers from down here, these calculations that we previously did. So I'm getting the current year, which is $1,824,000, plus prior year, which is $1,472,000, divide by 2. That gives me $1,648,000. Okay. I'm going to do the same thing now for 20Y6. For 20Y6, I'm going to get my 20Y6 number, which is $1,472,000, plus my prior years, which is the 20Y5, which is $1,000,000, and I'm going to divide by 2. Okay. And let's see what we get. We get $1,236,000. Okay. So now I've got all of my components that I need to calculate my formula. Okay. So net income that was provided in the problem for 20Y7, it's $372,000. I'm going to subtract my preferred dividends. My preferred dividends were $20,000. And I'm going to divide by my average common stockholders equity. My average common stockholders equity for 20Y7 is $1,648,000. And let's see what we get. 372 minus 20 divided by $1,648,000. Okay, we get that number, and we want it in a percentage form with one decimal place. That will give me 21.4. Okay. How do we do that if we're using a regular calculator? Well, it's 372 minus 20,000. That gives me 352, and I divide that by $1,648,000. I get that number. Once I get that number, I multiply by 100 to give me a percentage, and we look at the second digit after the decimal. If it's a 5 or greater, we round up. So because it is a 5, I'm going to round that 3 up to a 4. So that will be 21.4%. Okay? That is how we do it in a calculator. Okay? We're going to do the same thing for 20Y6. My net income for 20Y6 was $492,000. I'm going to subtract my preferred dividends of $20,000. And I'm going to divide by my average common stockholders equity for 20Y6, which we calculated it to be at $1,236,000. And let's see what we get. minus 20,123 divided by 1,236,000. Let me see. Oh my god, I got out of it. Okay, so let me try it again. 492 minus 20,000 divided by 1,236,000. Okay, and I'm going to have it a percentage and with 1 decimal place. So that'll give me 38.2. Okay, the key to these ratios is first, before you start trying to figure out the formula, is identify all of your components. Are they given to you or do you have to calculate them? If you have to calculate them, then calculate them first. So I calculated my preferred dividends, and this is for 20y7, 20y6, and 20y5. All of these will be that 20,000. Why? Because my preferred stock did not change. It was 500,000 every year, 4%. Okay. Now that I did that, I can calculate my average common stockholders equity. Okay. Well, for my average common stockholders equity, I need to know my common stockholders equity first. So I did my common my common stockholders equity by year. So I've got my calculations here. That way when I do my formula, I can be able to calculate my average up here using these numbers. Okay? So those are the 3 ratios that we are being asked to calculate. And then they're asking on letter B. What conclusions can be drawn from these data as to the company's profitability? Okay, so let me put a little box here. Okay, this is requirement B. Okay. So let's look at the first one. My return on total assets went from 16% down to 12% for the current year. So we see a drop in my return on total assets. So that's a drop. Then if you look at your return on stockholders equity, you went from 28.3 to 17.3, another drop. Okay. And then for return on common stockholders equity, you see another drop from 38.2 to 21.4. So what does that tell me? Okay. So we can say the profitability ratios indicate that the company's profitability has deteriorated. Okay. Most of this change is from net income falling from 492,000 in 20y6 to 372,000 in 20y7. So income drop causing an impact on the majority of our profitability ratios. Okay. Okay. Because the return on common stockholders equity exceeds the return on total assets in both years, there is positive leverage from the use of debt. However, this leverage is greater in 20y6 because the return on total assets exceeds the return on common stockholders equity by a greater amount in 20y6. Okay, and let me make this bigger. Okay, there we go. Okay, so If we compare the profitability ratios, 20Y6 to 20Y7, we see a drop in all three ratios. Okay, all three ratios went down from the prior year. Okay, where is my return? Because common stockholders equity. Okay, here we go. So when we look at the return on common stockholders equity, okay, the return on common stockholders equity, 21.4, 38.2 is greater than your return on total assets, okay, for both years. Okay, there is a positive leverage there from the use of debt, so that's okay. But this leverage is greater in 20Y6. So if we look at 20Y6 and compare, our leverage is much greater in 20Y6 than in 20Y7. Okay, because the return on total assets, okay, the return on total assets exceeds the return on common stockholders equity. Okay, by a greater percentage in 26. Okay, so if we compare 26, so it's 28.3 minus 16%, that's 12.3 versus 17.3 minus 12, that's 5.3. I had a greater amount difference between the two ratios in 20Y6 and in 20Y7. Okay, so this is basically the three ratio calculations, and we see a trend here where all of our ratios are decreasing year from the 20Y6 to the 20Y7. We need to figure out why, and one of those indicators is that my income is dropping. It went from 492 to 372. Okay, so we would have to analyze, why is my income dropping? Okay, net income is a major component in all of these analysis. If you see here, net income is included in all of them. So we would have to understand why net income is decreasing. We're not provided with that data here, but that's something that maybe we would have to look at to identify how can we improve. Why did our ratios drop significantly from last year to this year? Okay, so that is basically the second problem that we're looking at that deals with profitability ratios. Okay, now this last problem that we're going to be doing is horizontal analysis. Okay, so for 20Y2, McDade Company reported a decline in net income. At the end of the year, T. Burrows, the president, is presented with the following condensed comparative income statement. And then we're giving the comparative income statement for the company. Instructions: prepare a comparative income statement with horizontal analysis for the 2-year period using 20Y1 as the base year. Round percentages to 1 decimal place. Okay. Now I do want to let you know here that I did submit a help desk ticket with to Cengage because of the layout of the comparative income statement. Okay. I did a comparison of the prior textbook edition and the current textbook edition, and in this new current edition that they just released out in 2020, they went ahead and they included your expenses in parentheses or in like minus signs. So that is really throwing me off. In the real world, cost of goods sold, selling expenses, any type of expense account is not reflected in a financial statement in parentheses. They're all positives. Okay. They have a debit balance, so we know that. We know that we need to subtract our expenses from our revenues, but we don't report them in our financial statements as negative numbers, and that I'm having an issue with in this new edition of the book. So that is why I submitted the ticket, but I have not heard back. I've been getting the runaround, so they've scheduled a meeting for me to meet with the developers of the textbook because that is throwing me off. The last edition was correct. This edition, I don't know what they're doing, why they're making these numbers or why they're putting them into parentheses. I've been told that it's to help students better understand that an expenses is a deduction. But in the real world, you're not going to see these items in parentheses, so I don't know why they're doing it. Now, if you look at the Show Me How video in Cengage, yes, in Cengage, when they're doing the horizontal analysis on that Show Me How video, none of these numbers are in parentheses. They're all positives, how they should be. Okay, so I'm going to leave this problem as is. But when I do my calculations, if you see over here, I got rid of the parentheses because the numbers should not be in parentheses. Okay, I'll just have to wait and see what the publishers get when they get back with me, what they say their logic is to doing this. I've seen it throughout the entire textbook. I've submitted several tickets, but I still have not gotten a response. Okay, in the real world, whether it be an expense, your cost of goods sold, whatever the case might be, revenues, assets, everything is in positive. Okay. When we prepare our financial statements, we know, let's say for example, when we're doing our income statements, we know that revenues minus expenses gives you your net income or your net loss. Okay. So we know that. But now they've just incorporated that component. Okay. So that was just an overview of why I am not including the parentheses over here. Okay, so we're being asked to prepare a horizontal analysis. Okay, all I did is I set it up. This is the name of the company. So I just copied and pasted the information. Okay, these numbers are the same numbers over here. The only difference is that I did not put them in parentheses. Okay, why? Because cost of goods sold should not be in parentheses. We should know that sales minus cost of goods sold gives you your gross profit. Okay, but that number should be a positive. It should not be a negative. Okay, we don't report cost of goods sold as negative. So I went ahead and I copied the information. I excluded the parentheses because that, to me, it is not right. To be able to do the correct calculations, these numbers need to be positive. Okay. So, when we're preparing our comparative or horizontal analysis, we have to do two calculations. First is identify the difference in dollar amount, and then calculate a percentage change. Okay? So, the first thing we're going to do is we're going to calculate the increase or decrease, okay, in dollar amount. So, we're going to compare the base year, which is, they told us here that the base year is 20Y1, the base year to our current year. Okay, and we're going to figure out if that number went up or down. Okay, so we went from 15 million to 16,800,000. Did we go up or down? We had an increase. Okay, we had an increase of how much? We had an increase of $1.8 million. So from 15 million to 16,800,000, it increased by 1,000,000. By 1,800,000. Okay. Cost of goods sold. This is a cost. This is how much it costs you to manufacture the product. So you went from spending 10 million to 11.5 million. Did your cost go up or down? Your cost went up. Okay. Your cost went up by $1.5 million. So your cost increased from 10 million to 11,500,000. Now let me show you here what would have happened if I would have left these negative how they had it on this how they have it on this side. Okay, if we would have had the negative numbers kind of how they have them here in the problem, the negative 11.5 and the negative 10, then it would have shown as a negative 1.5. Okay, whenever you have a number in parentheses, that means a decrease. Well, my cost of goods sold did not decrease. My cost of goods sold increased. So this would be incorrect. That is why we don't use negatives in our financial statements, because then we misrepresent the information. Okay, so I don't have a decrease. Remember, decreases are represented by negatives. Okay, my cost of goods sold increased because we went from 10 to 11.5. So that means that my cost went up. They increased. So that is why very important that when you do your calculations, you don't include the negatives, okay? That way we can get the correct amount. What happened to your cost of goods sold? Well, we had 10 million last year. This year we had 11.5. My cost went up by 1.5. Okay? So, we're going to continue to the next one. My gross profit, did that go up or down? Well, my gross profit went from 5 million to 5.3 million. My gross profit increased by 300,000. Okay? So we go through each of these components and we identify if they increased or decreased. Okay? Selling expenses. I had 1.5 million in selling expenses. This year I have 1,770,000. My selling expenses increased by $270,000. Okay? My admin expenses went from 1 million to 1,220,000. So that means that your admin expenses increased by $220,000. So your total operating expenses increased by $490,000. So 2,500,000 was last year, 2,990,000 was this year. Your operating expenses increased by $490,000. Okay? Let's look at operating income. Now, let's look at operating income. This is a good one. Okay? Last year we had operating income of 2.5 million. This year I have operating income of $2.310 million. Did your operating income increase or decrease? Okay? Now this is where we're going to compare. Okay, once my computer loads right here. Okay, so we're going to compare the current year from the prior year, and I have a negative of 190,000. Why? Because my operating income decreased. I had 2.5 million last year. This year I have 2.3, so that's a drop. So your income decreased. Your operating income went down. Because your operating income decreased, then the number should be in parentheses. Only if it decreased. Okay? Other revenue. We had 225 last year. We have 256 this year. So we're going to go ahead. That should be an increase of 31,950. Okay? Income before tax. Income before income tax expense. Okay? Last year we had 2,725,000. This year we have 2,566,000. So my income is going to decrease. Okay? It should. Okay? And it decreased by $158,050. So we have a decrease because last year we paid, our income before income tax was 2.725. This year is 2,566,950. Okay? My income tax expense also dropped, okay, from last year. It dropped by 87,000. So you see, the negatives represent a decrease, the positives represent an increase. Okay? If you had all of these negative numbers like they do on this side, all of your calculations would be off. So it's very important that when you're doing your calculations, you assume these numbers are positive because they should be. Okay? I don't know why the publisher did that. Okay? And let's see what happened to our net income. Our net income dropped by 71,050. So last year I had net income of 1,225,000. This year I have net income of 1,153,950. Okay? So that is how we calculate our difference. You compare current year to prior year. Did it go up or down? If it went up, it's positive. If it went down, like in the case right here, from 2.5 to 2.3, if it went down, it's a decrease. Okay? Now we calculate the percent change. Okay? The percent change is going to be the difference amount that you just calculated. And you're going to divide it by your base year, which is 20y1. Okay? And they're asking us to round to 1 decimal place. Okay? So how do we do this? You get your increase or decrease amount, whatever you calculated in this column, divided by your base year. And that is how we get our percent change. Okay? So the increase or decrease in amount divided by the base year. Okay? That is how we do all of them. Okay? Same calculation, same concept. Okay? And I could just do a formula and scroll it down, but I want to show you all how all of these calculations are being done. Okay? So just divide. You see, and here, this number is a negative. Okay? Why? Because it represents that my operating income decreased. Okay? So how much did it decrease by? How much did your operating income decrease by? By negative 7.6%. So you had a decrease of negative 7.6%. That's what it's saying. A decrease because it's negative. Whenever you see a negative, that automatically triggers. Okay, if it's negative, that means I had a decrease in income, an operating income of 7.6%. Okay, so now we continue doing our calculations. So we just divide the dollar change by the base year. Okay. And that is what we get. So remember, when you're doing your calculations, I know that over here your cost of goods sold and all of your expenses are showing negatives. Please, when you're doing your calculations, forget that they're negative here. They should not be negative. They should be positive numbers. And then you compare, for example, selling expenses. Okay, did your selling expenses go up or down? Well, I had 1.5 last year. I have 1.77 this year. So my selling expenses increased by $270,000. Okay, so take into account, do not include the minus sign or the parentheses when you're doing your calculations, because if not, these numbers will be off. Okay, so that is how you prepare the analysis. Now you can say, okay, this is the dollar amount increase or decrease. This is the percent increase or decrease. So I can say my net income dropped by 5.8% from 20Y1 to 20Y2. Okay, I had a decrease of 5.8% in my net income. Okay, I had an increase of 22% in my administrative expenses. Okay, that's a pretty significant increase there. Okay, my cost of goods sold increased by 15%. Okay, my sales increased by 12%. Okay, your other revenue increased by 14.2%. So it puts it into a perspective of percentages versus dollar amount. Yes, you know, my selling expenses could have increased by 270, but what does that represent? Well, that represents an 18% increase. Okay, so that was the first requirement. My second requirement is, to the extent the data permits, comment on the significant relationships revealed by the horizontal analysis. I don't know if I can turn this off. Let me see. There we go. My faculty is having some conversations there, my team members. Okay, so the second one is, to the extent the data permits, comment on the significant relationships revealed by the horizontal data. So I'm going to do here, and let me do a little box. Okay, so let's start with net income. What happened to my net income? Your net income declined from 20Y2 to 20Y1. Okay, so we can say net income has declined from 20Y1 to 20Y2 by, net income has declined by 71,050, representing a 5.8% decrease. Okay, so net income has declined. Okay, we had 1.225 to 1,153,000. So net income has declined by $71,050. We have a decline representing a 5.8% decrease. Okay. What else happened? What happened? Well, my sales went up by 12%. Okay. So we can say sales have increased by 12%. Okay. Now here we have a however. Okay. The cost of goods sold has increased by how much? By 15%. Causing the gross profit to increase at a slower pace than sales. And I guess that didn't work. It's still popping up. Okay. What else happened? Let's look at our total operating expenses. Total operating expenses increased by $490,000, 19.6% increase. Okay. We can also say, in addition, total operating expenses have increased at a faster rate than sales. 19.6% increase right here versus 12% increase, 12% sales increase. Okay. Increases in costs and expenses that are higher than the increase in sales have caused the net income to decline by 5.8%. Okay. So we can see here, we can analyze from the information that yes, my sales went up by 12%, but my cost went up by 15%, and my total operating expenses went up by 19.6%. Okay. That's causing my net income to drop. Okay. So it's just information. This is just an overview. There's other information that you can analyze from the data, but I'm just going to do a quick overview here. It's very important that when you're looking at your numbers, you analyze and you say, okay, when I look at my base versus my current, did it go up or down? If it goes up, that number needs to be a positive. If it goes down, then in this case, that needs to be a negative. Okay. Don't use these numbers over here in negative, because if you do negative and negative, you're going to get a negative answer over here, and that's not correct. Like here, 10 versus 11,000,005. Okay. It increased by 1.5 million. Positive. So if it increased, it has to be a positive number, not a negative number, how they have it here. So just keep that in mind when you're doing your analysis. Okay. So that is basically the third problem that you're going to be having on your test. Remember, ratios, current position analysis, and profitability ratios have been calculated. And then finally here we do a horizontal analysis of an income statement. Those three problems you're going to see on your test. Okay. So hopefully this helps you get a better understanding of how to calculate each of the components. I provide you an overview of the corrections that need to be made because of how the textbook is structured for reporting your income statement. On the income statement, the numbers should not be negative. They should be positive. And the publisher has already been notified of this. I'm just waiting on a callback. But that is how you solve your problem. If you do this, then if you ignore those negative numbers, then all of these calculations will be correct. Okay. So that is basically it for this last lecture. If you have any questions, please let me know. Before finals week. Okay. Once the final exam becomes available, I will not be answering any content related questions. So if you are having issues with any of the problems presented in any of the chapters that are going to be on your final exam, please let me know immediately. That way I can answer them before finals week gets here. Okay, so that is basically it for this lecture. Have a great rest of your day. Thank you.